For decades, a specific number has dominated personal finance advice, dictating how millions of consumers manage their monthly expenses. The pervasive belief is that keeping your credit card balance exactly at or just below 30% of your total limit is the ultimate secret to maximizing your credit score. This widespread financial rule of thumb has convinced countless individuals to artificially carry balances, fearing that paying off their debt entirely might somehow penalize their creditworthiness. The reality of how algorithms evaluate risk is far more precise and entirely devoid of this arbitrary threshold. To understand the mathematical truth, we must examine the FICO score, a proprietary algorithm used by the vast majority of lenders to assess credit risk. Developed by the Fair Isaac Corporation, this scoring model analyzes consumer credit files to predict the likelihood that a borrower will default on a debt within the next 24 months. Within this complex algorithmic architecture, the second most influential factor, accounting for exactly 30.0% of the total score calculation, is the credit utilization ratio. This metric specifically measures the amount of outstanding balances on revolving credit accounts compared to their maximum approved limits. A revolving credit account, such as a standard credit card, allows a consumer to borrow against a predetermined credit line, repay the balance, and borrow again in a continuous cycle. This mechanism functions as a critical lever within the broader financial ecosystem, dictating the flow of capital and consumer opportunity. Lenders rely on utilization metrics because actuarial data consistently demonstrates a high correlation between maxed-out revolving lines and impending financial distress. When a consumer begins to exhaust their available credit, the algorithm interprets this behavior as a signal of cash flow instability, prompting a rapid downward adjustment in the overall credit score to warn prospective creditors. This brings us to the technical debunking of the 30% myth. The FICO algorithm does not contain a hard-coded target that rewards consumers for maintaining a 29% utilization rate while penalizing them for a 2% rate. The mathematics governing the scoring model operate on a continuous curve of risk assessment, where lower utilization is objectively and consistently better for the final score. 0% utilization is mathematically superior to 30% utilization. The persistence of this common guideline stems from behavioral economics rather than algorithmic reality. Financial educators and institutions historically promoted this figure as a psychological guardrail, a benchmark to prevent consumers from maxing out their accounts. Over time, this behavioral advice mutated into a perceived structural rule, leading to the widespread misconception that the algorithm requires a balance to generate a credit score. To master the mechanics of this system, consumers must understand exactly when the FICO algorithm captures this utilization data. The algorithm does not monitor credit card balances in real time, nor does it calculate the ratio based on the amount owed on the actual payment due date. Instead, the scoring model relies entirely on the balance reported by the lender to the major credit bureaus once per month. This monthly snapshot almost universally occurs on the statement closing date, which is typically 3 to 4 weeks before the actual payment due date. If a consumer makes a large purchase and waits until the due date to pay it off in full, the lender has already reported that high balance to the credit bureaus. The algorithm processes that high reported balance, temporarily tanking the credit score, completely blind to the fact that the consumer intends to pay the debt in full a week later. Understanding this timing discrepancy shifts the power dynamic between the consumer and the lending institution. By paying down revolving credit balances just before the statement closing date, a consumer forces the lender to report a highly favorable, low balance to the credit bureaus. This strategic timing ensures that the FICO algorithm calculates the utilization ratio based on an artificially minimized balance, instantly optimizing the resulting credit score without requiring the consumer to spend less money overall. The algorithmic calculation of utilization is further divided into two distinct mathematical evaluations. The FICO scoring model assesses both the aggregate utilization ratio across all revolving accounts and the individual utilization ratio of each specific card. A consumer might possess a low overall aggregate utilization, but if a single credit card is maxed out, the algorithm will still detect elevated risk and apply a penalty to the score. This dual-layered assessment acts as an early warning system for the macroeconomy. During periods of economic contraction, credit card issuers actively monitor these individual utilization metrics to identify consumers who are suddenly relying heavily on a single line of credit to survive. If the algorithm flags a rapid spike in utilization on one account, lenders may preemptively slash the credit limits on the consumer's other accounts to mitigate their own institutional exposure to potential default. The regulatory framework governing this data exchange is established by the Fair Credit Reporting Act. This federal law mandates that the information furnished by lenders to the credit bureaus must be accurate, but it does not dictate the specific day of the month that lenders must transmit this data. Consequently, the consumer is entirely responsible for learning the distinct reporting cycles of their individual financial institutions to maintain control over their algorithmic profile. Unlike payment history, which requires years of consistent behavior to build and recover from, credit utilization is highly volatile and highly responsive. Because the FICO algorithm does not maintain a historical memory of past utilization ratios, the metric resets entirely with each new monthly reporting cycle. A consumer who suffers a severe score drop due to a temporarily maxed-out card can completely restore their algorithmic standing within 30 days simply by paying down the balance before the next statement date. The penalties applied by the algorithm for high utilization are not linear. They escalate sharply as the ratio climbs through specific undocumented tiers. While 30% is often cited as a threshold, actuarial data suggests that crossing 10%, 50%, and 75% utilization triggers progressively harsher score deductions. A consumer moving from 10% to 20% might see a negligible drop, whereas moving from 80% to 90% could result in a catastrophic loss of points. These precise algorithmic deductions directly translate into the real-world cost of capital. A swing of 20 points caused by a poorly timed utilization report can easily bump a consumer into a lower credit tier just as they apply for a standard 30-year mortgage. Over the lifespan of that loan, the resulting increase in the interest rate can cost the borrower tens of thousands of dollars, all stemming from a fundamental misunderstanding of how and when a credit card balance is reported. The system inherently punishes the illusion of wealth built on leveraged debt. Many consumers conflate a high approved credit limit with actual purchasing power, utilizing their revolving accounts to fund lifestyles beyond their liquid means. The FICO algorithm strips away this illusion, mathematically penalizing those who treat their credit limits as extensions of their income rather than emergency reserves or transactional tools. There is one highly specific technical nuance regarding absolute zero utilization that warrants strict clarification. If a consumer pays every single revolving account down to absolute zero before the statement dates, causing every lender to report a zero balance, the algorithm may actually deduct a small number of points. This occurs because the scoring model requires at least one active data point of revolving debt usage to confirm that the consumer is currently interacting with the credit system. To navigate this microscopic algorithmic quirk, financial professionals utilize a strategy known as all zero except one. This method involves paying all credit cards to a zero balance before their respective statement dates, except for one single card, which is left with a negligible balance of perhaps $10. This tiny reported balance satisfies the algorithm's requirement for active credit usage, while keeping the aggregate utilization ratio as close to zero as mathematically possible. It is vital to recognize that the banking industry profits immensely from the confusion surrounding these mechanics. Lenders generate massive revenue from interest charges when consumers carry balances month to month, falsely believing they are optimizing their FICO scores. The algorithm, however, only cares about the reported balance, not whether that balance is carried over and subjected to an annual percentage rate, or APR. Paying a statement balance in full every single month avoids all interest charges while perfectly satisfying the algorithmic requirements for a top-tier credit score. The persistent myth that carrying debt is necessary for a good score is perhaps the most expensive misunderstanding in modern personal finance. The mathematical reality is that you never have to pay a single cent in interest to achieve a perfect credit utilization profile. True financial literacy requires discarding generalized advice and embracing the cold, objective mechanics of the systems that govern our monetary lives. The FICO score is not a judgment of moral character or personal worth. It is a highly specific, emotionless mathematical formula designed to protect institutional capital. By understanding the exact inputs that drive this formula, consumers can manipulate the outputs to their distinct advantage. The 30% rule is a relic of behavioral conditioning, a simplified guideline masquerading as a structural law. The algorithm calculates credit utilization ratios based on reported snapshots, rewarding the lowest possible balances and penalizing heavily leveraged accounts. Mastering this specific mechanism transforms credit from a source of anxiety into a precision tool, granting the informed consumer the power to dictate their own terms within the modern financial ecosystem.